Now once we work through the fair value adjustment, putting through the elimination entry of the investment is actually fairly straightforward. So as per normal situations, we credit the investment, the full amount in the investment that was put in to acquire control of the subsidiary. We then turn to debiting the pre-acquisition equity, but as we just discussed, we only debit the pre-acquisition equity, the parent's interest in those accounts. So the $2.625 million, the $525,000, and the $1.2 million. This difference gives rise to a $650,000 goodwill account, so we debit goodwill $650,000. Once we've dealt with the elimination of the investment account, we then move to eliminating intergroup transactions. There are a number of transactions here: a dividend, a loan with attached interest, and lease revenue. What I'll do, just for ease of purpose, is talk about the loan, the interest revenue, and the lease revenue first, and then talk about dividends second. Now, even though the group has some outside interest in it, being the non-controlling interest, AASB 127 paragraph 20 states that intergroup balances, transactions, income and expenses shall be eliminated in full. So when we look at the lease revenue and associated expense of that, when we look at the interest revenue, 65, and the associated expense, and when we look at the loan that the interest related to, the 670 payable to Corio and the 670 receivable from Yarra Park, all of these items are eliminated in their full amounts. What we're then left with is dealing with the dividends. Now the dividends are worked slightly differently, because of the $460,000 in dividends paid by Corio, which is a subsidiary, so I'll put this in, there was $460,000 paid. Of that, 25%, or what works out to be 115, actually leaves the group. Which means if we would eliminate that 115, we would actually be understating the amount of dividends that went external and actually outside this Yarra Park group. So we only eliminate dividends to the extent of the parent's interest. So we take the 460 and we multiply it by the parent's interest, and that will give you your $345,000. In this question, there are no other intergroup transactions to be dealt with. In reality, you're most likely going to see intergroup inventory sales with unrealized profits. You could well see non-current asset transfers. We won't deal with them at this particular point in time, but they are something that you need to be aware of.